Value at risk, VAR, is one of the most widely used measures of market risk in modern portfolio management. VAR estimates the maximum expected loss on a portfolio over a specified time horizon at a given confidence level under normal market conditions. For example, a one-day VAR of $1 million at a 95% confidence level implies that losses are expected to exceed $1 million on only 5% of trading days. VAR provides a single, easily interpretable risk metric that summarizes potential downside exposure across diverse asset classes. As a result, financial institutions, regulators, and portfolio managers frequently use VAR to monitor, report, and control portfolio risk. Three primary approaches are commonly used to estimate VAR: the variance-covariance method, historical simulation, and Monte Carlo simulation. The variance-covariance approach assumes returns follow a specific probability distribution, often the normal distribution, and calculates risk using estimated means, variances, and correlations. Historical simulation estimates VAR directly from past return observations without imposing a distributional assumption. Monte Carlo simulation generates numerous hypothetical future outcomes based on statistical models of asset returns. Each method has strengths and limitations. The variance-covariance method is computationally efficient, while historical and Monte Carlo approaches are often better suited for portfolios containing nonlinear instruments and complex risk exposures. Several factors influence VAR estimates, including confidence level, holding period, portfolio volatility, and asset correlations. Higher confidence levels result in larger VAR estimates because they capture more extreme loss scenarios. Similarly, extending the holding period generally increases VAR because risk accumulates over time. Greater portfolio volatility produces higher potential losses and therefore larger VAR values. Diversification can reduce VAR when asset returns are imperfectly correlated, highlighting the importance of portfolio construction. Because VAR incorporates both individual asset risks and correlations among assets, it provides a comprehensive measure of overall portfolio risk rather than evaluating securities in isolation. VAR is widely used in investment management, risk governance, and regulatory oversight. Portfolio managers employ VAR to establish risk limits, allocate capital, evaluate investment strategies, and monitor exposures across business units. Financial institutions often use VAR as part of enterprise risk management frameworks to ensure that aggregate portfolio risks remain within acceptable boundaries. Regulators also rely on VAR-based measures when assessing capital adequacy requirements for banks and other financial institutions. By translating complex portfolio risks into a single monetary figure, VAR facilitates communication among investment professionals, senior management, regulators, and stakeholders responsible for overseeing risk-taking activities. Despite its usefulness, VAR has several important limitations that investors must understand. VAR estimates losses only up to a selected confidence level and provides little information about the magnitude of losses beyond that threshold. Consequently, portfolios with identical VAR values may have substantially different tail risks. VAR calculations also depend heavily on assumptions regarding return distributions, historical data, and model specifications. During periods of market stress, actual losses may exceed VAR estimates because asset correlations and volatilities often change unexpectedly. Therefore, VAR should not be viewed as a complete measure of risk but rather as one component within a broader risk management framework. Sensitivity risk measures complement VAR by evaluating how portfolio values respond to changes in specific risk factors. Rather than estimating potential losses directly, sensitivity measures assess the impact of small movements in variables such as interest rates, equity prices, exchange rates, or commodity prices. Common examples include duration for fixed-income portfolios and factor sensitivities for multi-factor models. These measures help portfolio managers identify the primary drivers of risk and understand how individual factors contribute to overall portfolio performance. Because sensitivity analysis focuses on risk exposures rather than probabilities, it provides valuable insight into portfolio structure and sources of vulnerability. Scenario analysis extends sensitivity analysis by examining portfolio performance under specific hypothetical or historical market conditions. Instead of analyzing isolated changes in a single variable, scenario analysis evaluates the combined impact of multiple risk factor movements occurring simultaneously. Historical scenarios may include events such as financial crises, recessions, or interest rate shocks, while hypothetical scenarios can reflect forward-looking concerns. Scenario analysis helps managers assess portfolio resilience under extreme but plausible conditions. Because financial markets often experience nonlinear interactions among risk factors, scenario analysis provides information that may not be captured by traditional VaR calculations and enhances overall risk management effectiveness. Together, VaR, sensitivity measures, and scenario analysis form a comprehensive framework for measuring and managing investment risk. VaR summarizes potential losses under normal market conditions, sensitivity measures identify key risk exposures, and scenario analysis evaluates portfolio behavior during unusual or stressed environments. Each approach addresses different aspects of risk and compensates for the limitations of the others. Effective risk management requires integrating these tools rather than relying on any single metric. By combining quantitative estimates of potential losses with detailed analyses of risk drivers and stress scenarios, portfolio managers can make more informed decisions and improve long-term portfolio resilience.